This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
I'm on page 55, External Audit Report. This is pure F8 revision. To the extent that I'm not going to read page 55. Well, I'm going to read it at the same time that you're reading it, but I'm reading it in my head. The requirements of the standard, the audit report should include the following basic elements: title, address, C, opening or introductory paragraph, which includes identification of the financial statements audited and statement of the responsibilities. I'd like you to remember this actually. I'd like you to remember this little list here. It's pretty obvious. The title, the address, C, and the bottom three, the name, date and address. So of the, 8 bullet points, 5 of them are obvious. Title, address, C. The next one's obvious, the introductory paragraph. And the last 3, name, address and date. So 6 of those 8 are obvious. But then the opening or introductory paragraph and its containment, the identification of the financial statements audited and the statement of responsibility, the scope paragraph, a reference to IFRS or similar, a description of the work carried out, the opinion paragraph, a clear expression of opinion. I'm on page 81 of the Devro accounts. It's lucky I had so many copies of these accounts because some of you would have been without. But of course, if you had been without, I could have said, access Devro on the internet and just print off their accounts. It's a funny name, isn't it? Devro. D-E-V-R-O. Devro. Anyway, here we go. It's headed, isn't it? Title, address, C. The Independent Auditor's Report is the title. To the members of Devro PLC is the address E. And then a clear identification of the financial statements audited. We have audited the financial statements of Devro for the year ended December 11, which comprise the consolidated. The financial reporting framework that has been applied is the International Financial Reporting Standards as adopted by the European Union, and as regards the parent company financial statements as applied in accordance with the provisions of Companies Act 2006. So clear identification of the financial statements audited and reference to the IFRS. In the next paragraph we've got respective responsibilities of directors and auditors. Bringing to the attention of the reader as part of the education process, bringing to the reader's attention the extent of our responsibilities, and therefore also the extent of the board's responsibilities. Then the scope. Explaining to the world at large what an audit involves. Includes the assessment of whether policies are appropriate and so on. And then finally the opinion. A clear, unambiguous expression of opinion, leaving readers in no doubt what the opinion of the auditor is. No ambiguity, no vagueness. In our opinion, the financial statements give a true and fair view. You can't leave anybody in any doubt if you state something like that. Unless you want to argue and say, who knows what true and fair means. Date of the report, it's there in the second column on page 81. Down towards the bottom, it says Alan Wilson, for and on behalf of the firm of auditors. They're classified and identified as being chartered accountants and statutory auditors. Their address is Glasgow. Not Sauchiehall Street, Glasgow, it's just Glasgow. That's enough. If you were to look up in Yellow Pages for Glasgow, you'd find out what the precise address was. And the date, 12th of March 2012. Name, address and date. Alright, then we get into something again. Next page, page 56. This is an example of a Deloitte report. It's an independent auditor's report. It would have said somewhere, it would have said that the addressee is. It's on the Royal Bank of Scotland. It identifies clearly the financial statements audited. It identifies that. That's interesting. Endeavour, I've never noticed that. What an interesting thing that is. Oh, it is there. Clear identification of the financial statements audited. And then the second paragraph within the Deloitte's report, there is an equivalent paragraph in the Devereux report. This report, including the opinions in Devereux, this report, including the opinions, has been prepared for and only for the company's members as a body in accordance with Chapter 3 of the Companies Act, and for no other purpose. We do not, in giving these opinions, accept or assume responsibility for any other purpose or to any other person to whom this report is shown or into whose hands it may come, save where expressly agreed by our prior consent in writing. The limitation of liability. It arose, that paragraph grew out of, in fact it grew out of Royal Bank of Scotland audit, that previously they were audited not by Deloitte, but they were audited by another of the big four firms, and the Scottish court said that it's time the auditors, audit firms, realised that people other than the members of the company will rely upon the audited financial statements, and therefore it held the big four firm liable to compensate the bank that had relied on the financial statements. Now, it's a fundamental element of financial statements and audit reports that they are not intended to be used as the basis for making an investment decision. That's not the purpose, and that's why now we have this second paragraph in the Deloitte report. The report is made solely to the company's members as a body, in accordance with Chapter 316, 2006 Companies Act. Our audit work has been undertaken so we might state to the company's members those matters we are required to state to them in an auditor's report, and for no other purpose, to the fullest extent permitted by law. We do not accept or assume responsibility to anybody other than the company and the company's members as a body for our audit work, for this report, or for the opinions we have formed. This is a limitation of liability. It came about because of the case Royal Bank of Scotland and Bannerman. Bannerman is the name of the partner of the big four firm that used to audit Royal Bank of Scotland. And Bannerman and his firm were found liable and had to compensate the Royal Bank of Scotland. That instantly gave rise to this exclusion of liability clause within auditors' reports on public company accounts. Respective responsibilities of directors, the scope of the audit, the opinion, separate. It's the same as the Devereux one, isn't it? It's the same. Down at the bottom there, name, address, date. Alright, an unmodified, page 57, an unmodified opinion is expressed when in the auditor's judgment the financial statements do give a true and fair view and have been prepared in accordance with relevant accounting or other requirements. This requires us to do, amongst other things, consider whether the financial statements have been properly prepared using appropriate policies consistently applied, whether they've been prepared in accordance with relevant legislation, regulation or applicable reporting standards, and or that any departures are justified and adequately explained. And there's adequate disclosure of all information relevant to the proper understanding. ISAs define the following terms in the glossary. Financial statements, well, we've already covered that. Materiality, I've covered it, I've given you a quasi-definition, but if you read that one, this is the ISA's definition. Material, if its inclusion, omission or misstatement, could influence the economic decisions. It depends on the size of the item or error judged in the particular circumstances of its inclusion, omission or misstatement. So materiality provides us with a threshold or cut-off point, rather than being a primary qualitative characteristic which information must have if it is to be useful. The quasi-definition I gave you yesterday, an item is material if its inclusion or omission would likely affect the view of the financial statements in the mind of an informed reader. True and fair, overriding requirement in international financial reporting and auditing, that financial statements give us a true and fair view. We don't, however, define true and fair, and the law introduced the idea back in 1948, but it never defined it. Before 1948, auditors used to confirm that the accounts were accurate and correct. But then, following the 1948 Companies Act, we now confirm that they are true and fair, in our opinion, rather than accurate and correct. But there's no definition. True, information is not false, it's factual, it conforms with reality. It conforms with standards of law, standards and law. And in practical terms, it says that the financial statements are in accordance with the underlying records. Fair, information is free from discrimination and bias, and it's in compliance with expected standards and rules. In practical terms, the financial statements should reflect the commercial substance of the entity's underlying transactions. Its substance over form is a big element. Where will you find substance over form? It's within the framework. What's the framework? The framework gives us guidance as to the characteristics which should be apparent within any set of financial statements. Auditor's report must include an opinion on whether such a true and fair view has been given. Now there's interesting. If you disclaim because of pervasive uncertainty, your disclaimer of opinion says that because of the pervasive nature of the matters referred to above, we are unable to express an opinion as to whether the financial statements show a true and fair view. We are unable to express an opinion, but the law says the auditor's report must include an opinion. And yet in a disclaimer situation, we say we're not able to issue an opinion. So how does that satisfy the legal requirements? Legal requirements say you must have an opinion on truth and fairness. A disclaimer says we can't give you an opinion on truth and fairness. So how does that satisfy the law? Shall I tell you? Legal advice was taken on this. The profession sought legal advice, and the legal advisor said an opinion which says you can't issue an opinion is an opinion in itself. In our opinion, we are unable to express an opinion on truth and fairness, then that is an opinion. So a declaration of an inability to reach a conclusion about truth and fairness is an opinion. Courts will treat compliance with accepted accounting principles as evidence that the financial statements are true and fair. Again, this is something where the profession went to legal advice. And I'm going back a long time now. I'm going back 20 years or so. And the question was addressed to the legal profession in the UK, and it said, what role do accounting standards play in determining whether financial statements are true and fair? And in the build-up to their conclusion, two barristers, one barrister and his assistant, in the build-up and their argument in building up to the conclusion, came that memorable comment that said that the issue with each new accounting standard reduces the penumbral areas of divergent possibilities. Do you remember? We'd covered that at F8, and probably F4, and almost certainly at F7, and probably P2 as well. So we've come across it on a number of prior occasions, that the issue of each new standard reduces the penumbral areas of divergent possibilities. It reduces the penumbral areas of divergent possibilities. The word penumbral, I would not be surprised if you didn't use penumbral in your everyday conversation. I don't think there are many English people who know what the word penumbral means. It comes from the same root as umbrella. It does, seriously, it comes from the same root as umbrella. And umbra in Mediterranean languages is shade. And if you imagine that within that circle lies the world of truth and fairness, and outside the circle is not truth and fair, of course it's not a definitive line like that. Throughout the world of accounting and auditing, we have this shady grey areas where that may, lying on the apparent outside of the circle, that looks like it's not true and fair, but it might be. But equally, on the inside of the circle, something that looks like it should be true and fair actually isn't. So it takes account of substance over form, it takes account of the possible alternative ways of viewing a particular transaction or class of balance. And these are penumbral areas, these are the shady areas. And the issue of each successive accounting standard reduces these penumbral areas. It fixes a definitive line, and saying outside of that line is not true and fair, inside the line is. So with each successive issue, we're reducing the penumbral areas of divergent possibilities. If it were me doing this exam is it only 10 weeks? If it were me doing this exam in 10 weeks' time, do you know, I think I would make a conscious effort to bring in that expression about the reduction of penumbral areas of divergent possibilities. I think I would make a conscious effort to bring it in. I know certainly that a colleague of at least one of you in the room, a colleague of yours from the country to the north, who's now qualified, told me after the exam that she'd brought it into pretty well every answer in her P7 exam. She managed to get penumbral areas of divergent possibilities repeatedly into her exam answers. So it's a reduction of the penumbral areas of divergent possibilities as each new standard is issued. And that was what the legal advisors identified. They said as each standard is issued, it reduces these shady areas, and therefore to comply with standards is to comply with truth and fairness. If you comply with the standards which are in issue, then you are achieving you're achieving truth and fairness. That's what this bottom line, next to the bottom point, says on page 57. The courts will treat compliance with accepted accounting principles and standards as evidence that the financial statements are true and fair, do show a true and fair view. Ultimately, whose decision is it whether the accounts do or do not show a true and fair view? Whose decision is it ultimately as to whether or not the accounts do reflect a true and fair view? Who shall we ask? Raymond? No? Any of you ladies? Whose decision? Well, auditors is the answer I was expecting you to give. But it's not actually right. It's the auditor's opinion that the accounts show true and fair view, but the final decision as to whether or not they do is the court's decision. And if an audit firm is taken to court on the basis that they have issued allegedly an inappropriate audit opinion, The court makes the decision as to whether the opinion is appropriate or not. The opinion is given, but that's just in your mind. The court will say, yes, these accounts do show a true and fair view, and therefore the auditors were right with their opinion. Or, these accounts do not show a true and fair view, therefore the auditor's opinion was wrong, was negligent. So ultimately it's the court. And that was confirmed in the case Little John and Lloyd Chaham at the bottom of page 57. The accounts that were prepared and produced and published were in fact in accordance with standards. The quality of the audit work was questioned. The audit file was given to KPMG. They reviewed it and said we would ourselves have been proud to have had an audit file like this. There's nothing wrong with it at all, and the opinion is justified. And Little John, the firm of accountants, the firm of auditors that were the auditors of Central Trailer Rentals, they, inverted commas, escaped liability for negligence. They stood by the quality of their audit work. They said, no, we're proud of our audit work. We're proud of our quality. It's unusual for audit firms to go to court. I know you think it's not, because whenever you hear people like me talking, we always say in this case, the ADT case, the Caparo case, the Jed Fasteners and Marks Bloom case, the Little John and Lloyd, because these are cases which go to court. But the huge majority of cases never make it to court. It is quicker, cheaper, no publicity to settle out of court. Yeah, we hold our hands up, we're very sorry, here's a payment to compensate you. So most cases against auditors never actually make it into the court. A client will write to the auditor and say, you've caused us loss and damage, and the auditor say, well, we don't think we did, but we'll give your letter and our files to our insurers. And our insurers will review the situation, and the insurers will invariably say, settle out of court. It's not worth the argument. Let's just make the payment, and we will increase your insurance premium next year. So Little John and Lloyd Chaham said no to their insurers. They said, no, we want to fight it. And they did, and they won. They stood by the quality of their audit work. Top of page 58, ultimately true and fair must be decided by the court. When misstatements are identified by the auditor during the audit, the auditor should communicate all these misstatements to management on a timely basis, unless they're considered to be trivial, immaterial. They should ask management to correct all material misstatements which the auditor has identified. If management refuse, we need to obtain a thorough understanding of why they have refused. And we need written representations from management and those charged with governance, the non-execs, that they believe the effect of uncorrected statements is not material. Neither is it material individually, nor is it material in aggregate. But then we get to modifications. I've taught and I've given you an example, the Deloitte example. You have an example in front of you, the Devro example, of unqualified, unmodified audit reports. But now we're into modifications. And there are two types. There's a modification of the report and there's a modification of the opinion. The modification of the report, which is not a modification of the opinion, is the emphasis of matter. Emphasis of matter is appropriate, is applicable, when the auditor specifically wants to bring to the reader's attention some matter which is already included within the financial statements. In the context of Devro, it doesn't apply, but I'll give you the illustration as an example. The context of Devro, they could have said, let me find a shorter note. They could have said, we draw attention to note 21 on page 62, other payables - non-current. This note identifies that because of its significance, we're bringing it to your attention. We just draw attention to note 21. Now, they can do it in two ways. They can either say we draw attention to note 21, or we draw attention to note 21 which states that, and then repeat note 21. But it's not a qualification. And they will say, this matter does not affect our opinion above, or without affecting our opinion, we draw attention to. So I'm just about halfway down page 58. Matters that don't affect emphasis of matter. It's required to refer to a matter which is appropriately presented or disclosed. It is correctly, appropriately presented or disclosed, but it's fundamental to the user's understanding. It's really, really important. There may be other matters which require similar treatment, and they're called other matters. The auditor is required to refer to a matter not presented or disclosed in the financial statements, but which in the auditor's judgment is relevant to the user's understanding. Matters that do affect our opinion is a qualified. A qualified opinion will be issued. And it may be issued on the grounds of we disagreeing, or on the grounds of a limitation of scope, which gives rise to an uncertainty. A limitation of scope is where we are unable to obtain sufficient appropriate audit evidence. Whereas a disagreement is where the financial statements contain a material misstatement. Each of them has two levels, material not pervasive and pervasive. A matter that doesn't affect the auditor's opinion. This is the limitation, the emphasis of matter. I've talked about it. Can you read that first half page? Page 59. Okay. Matters that do affect the opinion. Here the auditor feels that because of certain circumstances, truth and fairness is not satisfied. It's either because we disagree or because we're uncertain with our limitation of scope. 2 degrees, I've told you, are material and pervasive. Material is where there's a material element of the financial statements, but it's in isolation. It is in an isolated area where the financial statements are, where the auditor disagrees with the figures or disclosure within the financial statements. Just a section, an isolated incident. Pervasive is where there's more than one, and the mistake, the material misstatement or the limitation of scope affects many figures or disclosures within the financial statements. Over the page, on page 60, you have the matrix. In all circumstances, when the auditor issues a modified opinion, we should communicate with those charged with governance. We will already have met with them before we formalise our opinion. We should explain the circumstances behind our decision to modify. And we should communicate the proposed wording of the proposed modification. I'm assuming that you remember the matrix from F8 about material not pervasive and pervasive, and the wording applicable where it's a limitation of scope or where it's a disagreement. The only one I think I need to briefly talk about is the material scope limitation. Except for any adjustments which might have been necessary, then in our opinion, And the scope paragraph would have a couple of phrases at the end of the scope paragraph. We carried out our audit, da-da-da-da-da, except that the scope of our work was limited as described below. So there will be an except within the scope paragraph, except the scope of our work was limited. Then between the scope paragraph and the opinion paragraph will be the detail of how or why, the circumstances of why our scope was limited, and then, except for any adjustments which might have been necessary as a result of the above matter, in our opinion the financial statements show true and fair view. A material misstatement concerning accounting treatment or disclosure, where the auditors conclude there is a material misstatement, then we should include in the opinion section a description of all the major factors which have given rise to the disagreement, the implications for the financial statements, where practicable a quantification, and if it's not practicable, then an explanation of why it isn't. And when we conclude that the effect of the material misstatement is pervasive and the financial statements are seriously misleading, that gives us an adverse opinion. In other cases, we have a qualification, it's just an except for. We can disagree in four ways. There are four ways of arriving at the situation where you're in disagreement. You either disagree with a fact or an amount, or you're in disagreement with compliance with law, or you're in disagreement with reference to accounting standards and compliance with accounting standards, or you're disagreeing with reference to the disclosure, the qualitative disagreement with reference to disclosure. So you've got fact and amount, accounting policy, compliance, and disclosure. Insufficiency of appropriate audit evidence, this is the scope limitation. There used to be others. There used to be other elements of uncertainty, but we're now reduced just to the one, where our scope has been limited. And scope is limited where we could have expected evidence to be available, but it wasn't available. Or where we couldn't have expected evidence to be available, and sure enough it wasn't. So we've been unable to obtain sufficient appropriate audit evidence about some material matter within the financial statements. Then we're limiting our scope. It's not a heavy qualification, except possibly that first one where we should have expected evidence to be available and it wasn't available. Then that may then have other implications, like, for instance, the reason it's not available is because the accounting records have been destroyed, and in that situation the company has failed to maintain proper accounting records, because it has to have proper accounting records available, and if they've been destroyed, then they have failed to comply. So limitation of scope may be caused by a disagreement with reference to maintaining accounting records, in which case you qualify twice, except the scope of our work was limited by, and then in the disagreement paragraph the company has, explained above, has failed to maintain proper accounting records. So down at the bottom and then page 60, where we've been unable to obtain sufficient evidence to express an unqualified opinion, then we should include a description of the factors which have led us into this situation. Indicate possible adjustments which may have been found to be necessary if our scope had not been limited. Should issue a disclaimer if the limitation is so pervasive that as a result of the importance of the limitation and the widespread effect of the limitation, the accounts are meaningless. That figure may be wrong and that one may be wrong, and we've been unable to obtain sufficient appropriate evidence about that figure, If it's a pervasive effect, the accounts become meaningless. And that would give rise to a disclaimer. And finally, a qualified opinion should be issued when the effect of the lack of evidence is not so pervasive as to require a disclaimer. The wording of the opinion should indicate that it is qualified as to the possible adjustments which might have been determined to be necessary if our scope had not been limited. (61) In considering the importance of a lack of evidence, the auditor should assess the quality and type of evidence which may reasonably be expected to be available. And we should assess the possible effect on the financial statements of the matter for which there is insufficient evidence. When the possible effect is, in the opinion of the auditors, material to the financial statements, then there will be insufficient evidence to support an unqualified opinion. We're on to Mombasa on page 61, example 1. During the audit of Mombasa, you will make sure, incidentally, won't you? You will make sure that you read that article I've just shown you from Accountancy Age, where Grant Thornton and BDO have been criticised by the Audit Investigations Unit for unethical and non-professional and low standards. You will read that, won't you, tonight? Because it illustrates again the importance of professionalism and maintaining standards and being an ethical organisation. And both of those organisations have been criticised. And you'll find that article in today's Accountancy Age, which you're going to read tonight and be tested on tomorrow. What are the 5 component elements of the Clarity project? Introduction. Next is objectives, then definition, and then requirements, and finally application. Hold on. Okay, we're on example 1, page 61. During the audit of Mombasa, it comes to your notice the entity has valued a certain line of inventory at a cost price of 7,000. The inventory has not been sold for a number of years. It's unlikely to be sold in the future unless it's reduced to 3,000. If the write-down were charged, it would have a material effect on the financial statements. How will this affect your audit report? Now, what you have to do here is you have to consider, first of all, materiality, but the question tells you it is material. This is not something which is unusual in an exam question. That she will give you a situation like this, your examiner will give you a situation like this, and you have to determine what is the effect on your audit report. And you then have to go through and say, well, first of all, is it material? And per the question, it is. But the examiner will not often tell you that it's material. Instead, you will be given figures for revenue, PBT and assets, or only 2 of those, and you'll be asked then to assess whether in the context of the question the adjusting entry necessary is material in the context of assets, or of profit, or of revenue, and that's where you come into the 3 test category, whereas Big 4 firms, or certainly one of the Big 4 firms, uses only 1 test category, just uses 1 figure for materiality. You would need to say, is it material there, there, or there? Sometimes it's not worth it. This one is not worth comparing with revenue. You would compare it with profit, you compare it with assets, but you wouldn't necessarily compare it with revenue. But you're told in this particular example that it would have a material effect on the financial statements. And then you need to say, well, what you should do, and there's no indication there, what you should do is you should discuss with the directors the adjustment that you would like them to make, where individually or in aggregate the required or requested adjustments are material. So we should discuss with management and point out to them that there should be a write-down of inventory, and as a result, if management refuses to amend their financial statements, then are we in the situation, are we limitation of scope, or are we disagreed? We're disagreed. Okay. Are we disagreed with reference to law, with reference to disclosure, with reference to fact or amount, or with reference to accounting policy? Fact or amount, and accounting policy as well, because the accounting policy should be to value in current assets at lower of cost and NRV. On the basis that we're now agreed, that you and I are agreed it's a disagreement, then what will be the effect on your audit opinion? On the audit, it says, what's the effect on your audit report? Are you going to emphasize? Are you going to give a clean report? Or are you going to qualify on the grounds of disagreement? If you're going to qualify on the grounds of disagreement, is it material or is it pervasive? It may be pervasive, but it's doubtful on the basis it's only the inventory. So the cost of sales, gross profit, net profit will change. Retained earnings will change and inventory on the balance. But it's only the one error. It's the overvaluation of inventory. So it's a disagreement, it's a material disagreement. On the basis that it's a material disagreement, what will be the effect on your audit report? Where within your audit report will you find reference to this disagreed item? Between the scope and the opinion paragraph. The scope paragraph will say we conducted our audit in such a way as to give us reasonable assurance that the financial statements are free from material misstatement. So that's the scope paragraph. Then you have the matter giving rise to the disagreement. During the course of our audit we came across this where the inventory is overvalued by 4,000. So quantify the disagreement if you can, and if you can't, explain why it's not quantifiable. In this one we can identify. So you'd quantify the disagreement and you'd identify what the effect was on the financial statements. As a result of this 4,000 overvaluation of inventory, cost of sales is understated, gross profit is overstated, and the net profit is overstated by 4,000, and you'd actually put in the new figures within your qualification, within your paragraph. Then you'd explain how the balance sheet was wrong, that assets and inventory and assets were therefore 4,000 overstated, and retained earnings are 4,000 overstated. And then your opinion paragraph. What are the first two words in your opinion paragraph? Except for. Except for the matter referred to above, in our opinion, the financial statements do show a true and fair view. Except for that matter referred to above, they do show a true and fair view. What about example 2, Pratchett? During the audit of Pratchett, you discover the entity has not kept any records relating to their cash sales. Pratchett has pre-tax profits of 500,000 and cash sales total 100,000. The entity has total sales of $1 million. Step 1, assess materiality. I'll go along with you so far. I may choose to argue with you later. What's material? How have you determined it's material? What have you compared with what in order to tell me that it is material?
Cash sales to pre-tax profits.
Cash sales with net profit?
Pre-tax.
I wouldn't have thought so.
Recorded sales to not recorded.
I would have thought you'd be comparing cash sales with total sales. So it's 10% of the declared total sales. Total sales should possibly be 1.1 million. They've not kept any records relating to cash sales. It doesn't mean that they haven't recorded the cash sales in terms of debit, cash, credit, revenue, but there are no records, there's no invoices been raised to record this cash sale figure. So in fact that cash sale figure of 100,000 is presumably included within the total sales figure. But it's 10%, and that clearly is material. Is it a limitation or is it a disagreement? I don't think it's a disagreement. I think it's a limitation. We could have expected evidence to be available and it wasn't available, and that's a limitation. It may be that that 100,000 is more accurate than the credit sales figure. It may be that they have sold exactly 100,000 in cash, and it may be that they have sold $899,000 on credit. So it may be the cash sales figure is more precise, more accurate than the credit sales record. So I don't think it's a disagreement, I think it's a limitation. We were not able to obtain sufficient appropriate audit evidence about an item which is material in the financial statements, and that therefore gives rise to a limitation of limitation of scope. If it is a limitation of scope, and if therefore you're going to modify your audit report, what is the effect on your audit report? Where will this limitation of scope feature within your audit report? Within the scope paragraph. We conducted our audit in such a way as to provide reasonable assurance, except the scope of our work was limited by the amount referred to below, by the item referred to below. Then you have the paragraph which explains that the company has failed to maintain records recording the cash sales. It says 100,000, and presumably that 100,000 is identifiable and quantifiable from the records. It's just that we have failed to raise invoices and we're not therefore able to confirm the 100,000 as being accurate. So we've quantified it. Cash sales included within the total sales amount to 100,000, for which no supporting documentation was available. Your next two lines, the next two words, next 5 words. 10 words. Except for any adjustments which might have been necessary as a result of this non-recording, in our opinion, the financial statements do show. Is it pervasive or is it material, this uncertainty, this limitation? It's material. Is it pervasive? I wouldn't have thought so. I don't think it's pervasive because it's only the revenue figure that we are uncertain about. But it may actually be the correct figure. So it's only the revenue and therefore the profit figure and therefore the retained earnings. Now then, we were unable to obtain sufficient appropriate audit evidence. Would we not be able to obtain sufficient appropriate audit evidence by conducting analytical review? If we can see that gross profit is 50% of sales, and it is, it's 500,000 profit and 1 million sales. If that's the standard, and we can check that profit percentage by looking at credit sales to see how much was the cost of the sale and how much was the sale value. So we can determine what is the normal gross profit percentage, and it looks like it's 50%. We could eliminate the cash element and say, what was the profit on the credit sales and what was the value of the credit sales, and we can find the profit percentage. If we then apply cost of sales to the overall cost of sales, we can work out what is the cost of the cash sales. And by then applying the gross profit to that, we can find out what the sale value of the cash sales was. And it may be that if we did that analytical exercise, we came up with a figure of 90,000 cash sales, 110,000 cash sales. And in that situation, would we not have then been able to get sufficient appropriate audit evidence to confirm that the cash sales figure, which has no supporting documentation, was in the range of acceptability because it was immaterial? I'm suggesting to you that this is not necessarily a material mistake or a material limitation of scope. And then we can do that if we can do that analytical procedure and determine that the 100,000 is about right, given the accepted profit percentages that the company is working with, then I think it will be reasonable assurance that the financial statements are free from material misstatement, whether arising through fraud, error, or limitation of scope. Except for any adjustments which might have been necessary, well, you would only use those words if it were material. And if you can do the analytical procedures to the extent that the difference, the potential difference, is no longer material, then I think you could give an unqualified, unmodified audit opinion. But I'm tending towards limitation of scope. That will be where I would be tending towards. Depends on the ability to do sufficient appropriate analytical procedures.